Right, that's a view coming in on the overall market. Let's connect then with Sunil Subramaniam as well, who's joining in on the show. And Sunil, just going by the kind of moves that we're seeing in the global markets, that nervousness, the kind of sensitivity that we saw to a lot of the data points as well that were released across the globe, that didn't quite percolate into our own markets. We have managed to hold out, and although it may be boring old consolidation, that perhaps would definitely be more welcome than any sort of decisive move on the downside. Would you agree?
Yes, I agree. Because I think domestic capital is not subject to international news. Your 23,000 crore SIP book, your domestic PMS, AIF investors, these I don't think are pulling and putting out money basis international developments. There are hedge funds from the US, there are algorithmic funds which will react, and hence the volatility naturally transfers to a market. But the consistent money available with domestic fund managers, whether they be insurance, whether it be PMS, AIF providers, or with mutual funds, I think means that they are waiting for the right opportunity when such correction happens. As you know, there are pockets in our market where valuations have run up, but there are other pockets which have not. So when such an event happens, the first tendency is to buy the pockets which have not run up so much, and then wait for those pockets to have run up because of the foreign selling to correct significantly and then step in and buy. So some degree of consolidation naturally will be there, sector rotation will be there, but overall, I think domestic capital flows are pretty healthy and strong to be a pin cushion to absorb these external related shocks compared to many years ago.
Sunil, hi, morning. But where do you think that domestic flow is going to find its way? Because, you know, the sectoral churn in the market is coming in with a very, very fast pace. You don't know where the next dollop of money is really going to come in.
So see, what's happening here is that the money is coming to the hands of fund managers. I don't think people are making those allocation decisions, except for, say, putting into a thematic fund, like a defense fund or energy fund or an innovation fund, right? People are making those allocations at a very broad level. Ultimately, domestic fund managers have got a very close look on valuations, growth potential, recent earnings, economic outlook. So that smart money is actually going and picking the right step. So I would say that it's the fund managers who are actually deciding now where to allocate. Take IT. They've been a laggard for such a long time. Now they are seeing the run-up because softness in the US interest rates is good for them. You know, so to that extent, I think that the quality of domestic fund management, whether it's the, like I said, PMS, AIF, a lot of senior fund managers stepped in. So I think that domestic investor allocation is not as important as domestic fund manager allocation, and that's what is continuing to let this sector rotation play out.
Okay, fair enough. And just curious as to how you think investors should be positioning themselves. Is it a time to sort of take comfort within some of the defensive sectors, play, with just a sprinkle of high beta, or just sit it out and wait it out with existing positions? What should be the allocation in your view?
So if you're doing through mutual funds, then flexi-cap and multi-cap funds are the best, because they're the fund managers exercise the discretion. 6 months ago, they would have been put into some sectors and some cap curve. Today, they'll be very different. So one way to do it is do that. But if you're doing your own allocations, right, what I saw recently is that thematic flows have, NFOs have collected a lot of money. So clearly, retail investors are preferring these thematics. So I would say on an average, a retail investor's portfolio, if he has invested over the past few months, would have overstocked up on these thematic play. So then today is the time to move defensive. And I think consumption, banking and financial services, IT, these are, and a little bit pharma, are more defensive, which haven't had the kind of run-up which the others have done. So I think that's more what they should be doing. Definitely adding a little more defensive to their portfolio, because overall cut in the US interest rates is positive for equities and positive for emerging market flows. And as you know, overseas flows are significantly passive driven. So passive money will come across all sectors.
All right. Looks like somebody is trying to get in touch with Sunil Subramaniam. I could hear the ringtone, phone ki ghanti. You remember in COVID, we used to hear pressure cooker ki ghanti.
Pressure cooker ki CT,
yeah. Ghar ki ghanti and pressure cooker ki CT.
Yes. From all of our homes.
Some days.
And now it seems like it was so long back.
That's what happens in markets. That what looks very big at that moment